Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, debt reduction and investing, part 3 in our series on National Financial Literacy Awareness Month. I want to be able to build my credit up, have a good FICO score, and I want to be able to invest. But I got to take care of my credit and understand it. And if I become a good steward of my credit, this is going to be halfway down the road to financial literacy and looking at financial literacy as a good stewardship issue in my life. When I'm looking at building credit history, I'm looking at mine, like I have to say, confess, my first 10 years of marriage, my FICO score, I don't even know they did FICO scores back then, but let's just say my credit, I was buying things that I couldn't afford, impulse buyer, using my credit card unwisely, not being a good steward of my money. When I kind of woke up to this in my mid-30s, I started to become more diligent and a lot more disciplined. Now, when I'm building my history, like right now, I think my FICO score is like 810. Well, I'm in 1% of America that has high credit rating. Now, here's the deal, of course. High credit rating for what? I'm not in debt. I don't want to get in debt. I've already bought the last home I have. I'm not making mortgage payments. So to me, building credit in the history now is kind of over for me. But if you're beginning in your 20s, this is the most important thing because you're going to need some credit sometime for a home. You're going to need some credit because most people can't pay cash for an auto. You have to get the best rate. If the higher your FICO score is, the lower the interest rate is. Did you get the correlation? And you want to be able to always pay the least amount of money for any money that you're borrowing. So if it's your mortgage, auto, home, or college education, I want to pay the least amount of money to enter into those ideas. Some people say college is an investment, not a cost. But if it's an investment, I have money I still have to invest, and if I don't have it myself, I'm borrowing it to do so. So when I'm looking at credit, I want to have a good history. I want to know my FICO score. I'm going to look at some of the, like Equifax or TransUnion or some of these other places that actually look and monitor our credit. And remember, I want to pay on time. If I have a history of not paying on time, that could ding my account. If I have a possibility of not paying at all and I miss a payment, that's a problem. Now, there are cards that give you a one-time forgiveness. Oh, you made a mistake, you couldn't make the payment. They're going to give you a 1 month kind of a forgiveness idea. But bottom line, you usually get 1 or 2 and you're done. So you want to make sure that whatever credit history you're building, it's really building a good number that you can use for mortgage, college education, and auto. After that, I don't know why you're going ahead and borrowing. The basics of investing. I can't really start investing until I'm out of the area of heavy debt. Now, why would I pay ongoing college educational debt and invest? Well, one part that I might want to invest in is a 401k if my employer is matching any of my contributions. So let's talk about that first. If my employer is actually matching my contribution, I'm doing that all day long, that's free money. Even if you didn't want to be in the market, even if you didn't want to be, you could be in a money market and your money would still double because whatever money he matched or she matched as your employer, you'd be getting that. That's free money. You need to take that money and run. You need to do that all day long. So even though I might be trying to reduce my debt, I'm going to go ahead and invest in my 401k, which is investing in my future and my retirement because I'm being matched. If I'm not being matched, I still want to take down my student loan debt first. I want to set myself up so I can get a decent mortgage and so that I won't be declined, and I want to be able to pay my credit cards off on a regular monthly basis. I don't want to pay interest. It's way too high. Most cards are double digit. As we see the Fed tick up rates, you're going to see credit cards slowly go up as well. So we want to be out of debt, or we want to be able to pay off our credit cards in a timely fashion. But I do want to invest. So my first thing I want to do is look at my 401k. Am I going to get a match from my employer? If they say they're matching, I'm doing that all day long, even though I might be still paying down debt. It's important. You're going to be looking at investing in a different way. Before you invest at all, you must take a risk tolerance test. A risk tolerance test is not perfect science. I never said it was, but it is a good indicator of where you are in your psychology on money, your attitudes towards money. So you want to start looking at what is good conservative. If I'm conservative, I'm moderate or aggressive. The younger you are, you might take the position that I have so much time on my hand and I've seen the historicity of the market go up, down. It has its peaks and valleys, but it continues to kind of go up. You might feel comforted by that. But remember, history is absolutely no indicator of future performance. So even though the Ipsen chart keeps going up and down and it has its peaks and valleys, it's still not a historical truth that you can bank on for future returns and performance. You may look at stocks. You might want to look at mutual funds. You might want to look at ETFs. You might want to buy bonds or cash equivalents. It doesn't matter. You have to first do a risk tolerance test to see what kind of investor you are. Now, in the generic, you're either conservative, you're kind of a moderate risk, or you're an aggressive risk. And remember, you have to measure all that out. If I'm sitting there in my 20s and 30s and I understand the market cycles, I'm good with my retirement money maybe being more moderate aggressive, or maybe even aggressive. But what if you're a almost senior, you're in your late 50s, you're heading towards retirement, you can see the finish line. You may start pulling back, you may start modifying your position in the market. You're gonna have to look at that. And the biggest issue is you definitely wanna be out of debt before you become a senior. Think about this. The baby boomer generation is the first generation in all time where we have never paid off our mortgage. We have baby boomers going into their retirement without paying their mortgage off. They were paying their college tuition to their children. They're paying the long-term costs of their parents. They've been sandwiched in between, and they have not retired their mortgage. There's ways to play that game, and you should look under the house equity conversion mortgage. I wish I had time to talk about that, but I don't. That could be a play for you. And when I do all my live seminars, I always talk about it. But you need to look at getting out of debt. If you're almost senior, you should be getting out of debt. If you said, Steve, where can I invest my money? I say invest it in reducing your debt before you retire, and especially your mortgage. You do not want to have mortgage commitments going into 65, age 70. You just don't. Now, when I'm looking at basics of investing, I want to make sure that I have done my risk tolerance test, and I'm looking at the understanding of what basic sector. The market is really correlated. We live in a global society now, so things that happen overseas could affect us. Things that happen to us affect overseas. We are really a correlated market now. So you have to start to understand that. You say, well, why are problems in Asia affecting the market here in the United States? Because we're trading all the time on a world environment, and you have to understand that. So you're going to be looking at your sector. You're going to be looking at growth funds. You're going to be looking at value funds. You're going to look at market caps. You're going to be looking at investing in stocks. You're going to start conditioning yourself. Equities are going to bring me the inflation defeating performance. That's my hope, right? That stocks and dividends perform in such a way that they always outpace inflation, so that the power of my purchasing dollar is always buying better than my dollar was yesterday. Think about this. When I think about filling up my senior year in high school at 31 cents a gallon, and today I think I paid $2.21 before I came in here. Actually, that's a pretty good deal for all that time. But back then, that was very small and very cheap. Should I have been in oil stocks all this time? Should I be getting out of fossil fuels and into the new technology of energy? We have to look at all those things, and you have to become kind of a student. And this is where you need to partner with a registered investment advisor or a registered rep who is licensed to sell securities and has a history. They have to have a history. And by the way, make sure you go on brokercheck.com. I mean, this is Financial Literacy Month. One of the first things you do before you have anybody talk to you about their money, including myself, you need to go out there and see if they got any bad boy issues on their behaviors. I cannot tell you time and again, I have people that are out there speaking on behalf of money that have been banned by FINRA and the SEC. I don't see how we can do business with people who have a rap sheet looks as long as any other felony I've ever seen. So you got to be careful. Always do your due diligence. Check their background, their Department of Insurance for their state, and brokercheck.com, and you'll be able to see if they got any issues. Now, I want to be able to create a portfolio based on my psychonomics, which is, how did I get to that? I did a risk tolerance test. It got me in the game. And remember, if you're married, you want to take the risk tolerance test separately from each other. You don't want to look over the shoulder. You want to do this independent. So I have two distinct personalities actually doing the test and looking at those two areas so I can determine, hey, what can we do that we do agree on, and what can we do to stay in our separate accounts? So you have to remember, you need to measure that. You need to know what that means. So when I'm looking at my risk tolerance test, I'm going to be looking at the stock market big time. And as I get older, I'm going to start doing stock market and bonds, maybe a balanced income fund as I get into my 50s. But when I start getting into my 60s, I'm going to start moving more and more out of the market. Now, right now, I'm very close to getting close to retirement date. I have about 12% in the market. The rest of it I've already converted either to income or assets that are good, interest bearing. always will have to stay in the market to get the edge off inflation. The market will hopefully outperform inflation so I can keep my purchasing power of my dollar. But as I've gotten older, I've started to pare back and become more conservative. Depending upon your age and depending upon your goals, you have to look at the market and make it work for you, not the other way around. Don't forget to watch our next segment on the fundamentals of investing, part 4 in our series on National Financial Literacy Awareness Month. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, or financial advisor. You've been watching Steve Savant's Money, the name of the game.